You're watching Stock Watch this week. I'm Ntaoleng Lechela, and joining me to unpack your stock-related questions today via Zoom is Kearabilwe Nonyana from Scope Prime Africa and Alex Duys from Umthombo Wealth. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392, or on X at Business Day TV using the hashtag StockWatch. Gents, thanks so much for your time this afternoon. And let's start off with you. Quite a busy week. We've had earnings coming through. We've also had some economic data out of the US. Retail sales increasing in June. The job market seems to be resilient, with weekly jobless claims declining. What have you made of some of those prints and the sentiment, or what it suggests for the US economy?
I think the sentiment still remains that essentially the U.S. economy is still in an era of prosperity, and that's filtered through to the market space as well. Because I think what had happened when there was this introduction of these tariffs is that the outlook statements kind of just tapered off, and a lot of management teams essentially just dialed back on their estimates. So right now, seeing earnings coming out with a lot of beats, and when you look at the breadth of the market currently, there's almost been close to 86% of just beats in earnings. It just speaks to the fact that the U.S. consumer is still very strong, and that economy is still chugging along, even though there are some headwinds in terms of the political leadership.
Yeah, and that, of course, being echoed by the big U.S. banks, pointing to a healthy consumer and somewhat of a stable economy. Most of those counters, as you mentioned, beating market expectations. Perhaps Alex, you can walk us through some of those numbers, those banking numbers, and a counter that came out tops for you.
I mean, the banking guidance specifically, I think was very encouraging, because they do not anticipate really a bad debt cycle to emerge. And the data that they are collecting at a particular moment is looking better than perhaps feared a few months ago. So I think that's a very big positive. Obviously, as alluded to now, the US consumer has been more resilient, and I think shouldn't be underestimated as well going forward. So I think some of the negativity towards United States economic prospects is perhaps a little bit unfounded. I mean, that they are by far the world's biggest economy, and they are still in massive stimulus, right? So they've been on stimulus pretty much since 2008. And hasn't stopped. I mean, the so-called big beautiful bill is another stimulus spending that they're going to do, right? So I think the American economy will continue to chug along. Obviously, the real risks will eventually start to emerge at some point in the horizon, specifically the debt issue, because that's something they need to address at some stage. But as long as they've got reserve currency status, and as long as they've got the AI advantage and capital flows to the United States, they can continue as it is in the moment. So I think that the numbers and guidance we've seen from the banks are encouraging for US, and perhaps the US GDP numbers that we have is perhaps a bit on the low side of the equation. I'm talking about the consensus estimates.
And let's get into some of the questions then. A viewer here asking for your view on Netflix and whether it's a buy at these levels, Kia.
I think with Netflix, so the question you always have to ask is essentially how much are they going to be spending on content creation, and how does that depress margins? But if you're looking at user growth, Netflix is always in positive territory. And essentially right now, the question you have to ask yourself is, with the competitors within that ecosystem, who is going to continuously draw new subscribers? And Netflix seems like they've always have the advantage of having content that draws new subscribers. At these prices, it's a bit elevated, but I still think it's a good company and a long-term buy in my books.
And Netflix actually pointed to that in its results, saying they've benefited from higher subscription prices in addition to ad sales. Just your then view on that counter, Alex.
Yes, I don't look at the company in my professional capacity, so I can't comment on the valuations and so forth. But perhaps to touch a little bit more qualitatively on the business. I mean, certainly they've got a structural advantage because of all the billions they've sunk already in content. So that makes it very difficult for competitors to come in. They've already expanded, of course, pretty much across the entire globe at the moment. So once again, very difficult for competitors to come there, and they are a household name. Most people have a subscription or plan to have a subscription with them. So that gives them some pricing power, and they probably will need to spend less on content going forward than have done in the past, because of the big backlog they have, and perhaps they'll be more smarter now on the capital allocation, knowing what programs is required. You don't need to spend 200 million on a movie. You can perhaps make 10 movies of $10 million, something like that. So I think the traction I've seen over the last couple of years from growth and so forth, it seems to me, observing it from here, that it can continue.
All right, let's move over to the chip industry. Another market-beating quarter from TSMC. I think profits were up over 60%, of course, benefiting from the AI boom. Viewer asking for your analysis on the stock, Alex, and whether it is a better in on the AI story than NVIDIA.
Look, unfortunately, I don't cover any international stocks in my professional capacity, so I haven't got a chance to go for a result or give an informed view. I mean, so I'd rather not give a view. I can give a view, but it's not informed, unfortunately.
All right, let's give that question to you then, Gia.
Yeah, no, I mean, essentially, I think it is a better entry, but I think it in different component parts. I mean, if we look at the ASML results, which also came out, I mean, they have a specific part in that value chain on that foundry of the chip making, and they have this continuous ability to have margin integrity. And that's what I'm seeing across the earnings of all these chip makers, is that they'll be able to, even in times where costs are rising, they're able to pass on those costs to the end consumer because of this AI generation boom. And essentially, it even leads to downstream industries, which essentially are very energy intensive, and you've seen that even flow into the commodity prices. And truly speaking, I think TSMC, for me, is a better entry than NVIDIA, just purely on valuation basis.
And what's your take on ASML? The numbers were good, but they did issue a growth warning. I mean, is it on the back of uncertainties around tariffs, particularly the fact that the EU and the US haven't reached a deal?
I mean, if you look at the anticipation for the next quarter, it's almost in guidance with what they achieve now in net earnings of about 7.9 billion, and essentially looking at the same net margin figures between 50 and 53. So to be perfectly honest, it comes back to the fact that the uncertainty lies in tariffs. I don't think if you're looking even at the net bookings, which are about 5.5 billion, that you'd anticipate that revenue is going to be on the decline. I just think sometimes with CEOs, they don't want to be too forthright in terms of how well they're doing. And because of the fact that we have a politician in the White House who's also very erratic, they'd rather keep market expectations down and essentially keep on beating earnings. They are sitting on almost 7.7 billion euros in cash as we speak. I mean, they could essentially buy ABSA, as Simon says.
Let's move over to the pulp and paper sector. I'll give this one to you then, Alex. Zooming in on your take on the sector. The question reads, is Mondi a better representation of the outlook of the pulp and paper sector?
Yeah, not really a sector that I find particularly attractive, particularly over the medium to long term. But I mean, you can make, if you buy down cyclical lows, like perhaps where Sappi is at the moment, it could be opportunity. But Sappi does have quite substantial headwinds and also got quite a balance sheet issues. So that's something to be cognizant. So I would say quite a high risk investment case there. Mondi's got more of a packaging component to that. So, you know, as we continue to do more online types of orders and so forth, think about Amazon and the corrugated packaging that's required for that. That obviously they are aligned to that, and they obviously produce in cheaper Eastern European countries and so forth. So I think that valuation for me looks relatively okay. However, the guidance they had was a little bit worse than anticipated. So they're also going for a bit of a cyclical low at the moment. But if I have to choose one of those two, my preference would be for Mondi, but I don't really think these are type of buy and hold type of companies. I think the longer term fundamentals just doesn't really sit well with me at the moment.
And what about you, Gia? Mondi or Sapi?
No, I wouldn't even touch Sapi with a 10-foot pole. And essentially, it's you see, it's the headwinds that Alex speaks about, and essentially a very opaque balance sheet. And I think in this regulatory in this environment that they're operating in South Africa, pulp and paper is almost non-existent as an industry. But I think, as Alex says, Mondi is more a function of what do we think is going to happen in the EU economy, and essentially where consumer confidence is going to come from. As you said, Alex, I don't also think that it's a long-term view that it's a buy and hold, or it's in a structurally declining industry, which essentially is seeing higher operating costs. And truly speaking, if I had to choose, I'd choose Mondi. But as Alex said, I also wouldn't want to be in this industry in any portfolio of ours.
Let's kick things off with Sasol. It is a fave here on Stockwatch. The viewer asking if it is a buy at these levels, Alex.
I mean, structurally, I've got major reservations about the business. That's simply not competitive on a global perspective anymore. Massive balance sheet issues. And also, if you think from a global investment perspective, why would you want to buy Sasol over any other global and oil and chemical companies, right? So those are the structural issues I have with Sasol. It is simply not the same quality business it was perhaps 20 years ago. But saying that, I mean, if we do see a big recovery in chemical prices and oil prices, then Sasol is extremely geared to the upside in that regard. So I can see a scenario where Sasol can do 102, 300% potentially. But I can also see a scenario where Sasol slowly goes into oblivion. So it's a very difficult one. I would say for investors who've got high risk tolerance and perhaps more of a trading stock as they're looking to buy and hold, because something can go wrong down the line the longer you hold it.
Yeah, and the oil price, a catalyst for that share price. We did see some highs over the past few weeks on the back of the geopolitical tensions over in the Middle East, but that, of course, dissipating as the tensions there simmered down. Your take on Sasol, Gia? I mean, the company also had a capital markets day. Just to reassure investors, are you buying into that turnaround story?
To be perfectly honest, I'd need to see more from management to actually say that I'll buy in. As Alex was saying, there's a lot of structural problems in that business, and even on a short-term trading basis, I mean, which is what we do here. I mean, there's quite a dislocation in the correlation of the oil per rand price as well as Sasol. And that dislocation comes from the fact that these structural issues continue to persist. As I said, there's probably better counters to go and take advantage of short-term trading correlation between the oil price and the share price offshore than they are on Sasol locally. But with that being said, I mean, over the past few weeks, I've seen some trading volumes which should suggest there's a bit of institutional buying in Sasol. I mean, on the 15th of July, I mean, almost 400,000 shares traded within the first hour and a half, of which, I mean, the daily volumes are just under 2 million shares traded, which shows that there is a buyer in the market. But since that day, there's been a seller who came in and dropped their price.
So there are buyers in the market, but it's not Alex and it's not Gia. That we know for sure. Let's move over to the retail sector. How do you see retailers? I think this is a question particularly about those grocery players. The viewer asking about Pick n Pay in particular and how it's faring, Alex.
Okay, so I think Pick n Pay last set of results I thought was slightly better than perhaps the market was looking for, but they still got a mountain to climb.
Yeah.
And I think that is important to note. It's still a very, very difficult slog ahead of them. But now at least they got the money in the bank, so they are fighting now with two hands where they used to have one tied at the back. So I think that's a positive. If someone can get Pick n Pay on the right route, it does feel to me like Sean Summers is the person to do that. But it might need more time. And it's probably more complex than we think it is. So I think that those are the issues there. Obviously, they've still got a big chunk of Boxer, which helps because I do think Boxer's growth path it's much less complex. They might, over a period of time, slightly disappoint, but if you take a 3-5 year view, I think they're going to do quite well. And that could obviously help them a little bit during this period. So my preference in that space is to rather be a boxer despite the valuation, because I think the cash earnings is very, very strong. I think some investors is just going to focus on the accounting earnings, which I think is a mistake. Focus on the cash earnings there. While Pick and Pay, it's more of you have to assess it on a by yearly basis as the report results. Are they on the right track or not? And you make assessments based on that. So not easy, but potentially I can pull it off. But watch it very closely.
And how would you play that boxer exposure, Gia? Would you get in cheaper with Pick and Pay, that's what, about 26, 27 Rand? Or would you go directly and buy boxer, which is about 68, 69 Rand?
Essentially, when you do a sum of the parts, I mean, you essentially would want to enter directly through Pick and Pay, because then you get the Pick and Pay business. But I mean, what was quite concerning in the last set of results is the higher costs, and I mean, even if you take away the fact that they had an extra trading week, I mean, things were just not looking great with Pick and Pay. And as Alex just said, maybe Sean Thomas is the guy for it, but this is a long-term play if indeed you want to bet on Pick and Pay. Boxer is just a better business just because of where it is targeting. But if I had to do an analysis on this retail sector, it's ShopRite and then the rest.
Okay. And then a view on the property sector, particularly office property, and whether the fundamentals for the office property are improving. And if they are, why are big players still ditching some of those assets? I think this is probably on the back of Redefine disposing of, I think it was Rosebank Corner. Alex?
I think we have seen to some extent a pivot in the office fundamentals in South Africa. If you look at, for example, like Grove Point, which has underperformed Redefine from office perspective over the last few years, there seems to be a bit of a pivot there. You're starting to see valuations picking up, negative reversions are coming down, and it's starting to sign a bit longer leases and so forth. And you want to ask why? Well, firstly, if you look at places like Cape Town and so forth, the business outsource processing has been getting quite popular in South Africa. And as a result, that they've been taking up a lot of office space. And there's lack of new supply coming in because of the lack of GDP growth. So eventually some of these office values are starting to pick up from a very big bear market. So yes, like Redefine, Grove Point will benefit from that, but I still don't think this will going to be call it a sexy market, or you're going to make a huge amount of money. But I do think there's been a pivot in the fundamentals.
And are you seeing value there, Gia? We've seen some of these counters also start beefing up that, logistics kind of industrial property play. Some of the ones that have been doing quite well also have exposure internationally. I'm thinking of the likes of Vukile as well, doing really well in Portugal and Spain.
Yeah, I mean, this sector, as Alex says, is just not sexy enough, and essentially, it's an income play if you're going to be taking any exposure in the sector, and if you even with about 146 billion leaving our bond market, our bond yields in the belly of the curve are still about 9.8, and on the longer end closer to 12. I'd rather, in terms of if I had to compare those distributions of the likes of Growth Point and Redefine, I'd rather take my exposure to income through government bonds, and South African government bonds at that. With that being said, I think what you said about this offshore play, something like serious property, serious real estate, is really quite interesting because it's benefiting from this new spend of defense spend by NATO, because it's investing in these industrial parks where these aerospace and defense systems manufacturers are operating in Germany. So that is one that I'll take a play on, just purely because of the sector-specific growth in the aerospace and defense space in Germany at the moment.
Okay, so let's move over to the mining sector before we get into stock picks. The viewer asking for the panel's view on BHP, a 5 to 10 year view on the miner. Yeah?
Now, BHP, I mean, they came out with record production on copper on this copper price, which is quite elevated in the first half. I think in terms of base metals, copper is still going to be very important as a conductor for this AI generation boom. And looking at the fundamentals of copper production, because of droughts in areas where it's mined, and as well as a copper deficit going into 2035, there's still going to be a quite rightly elevated copper prices. And if you have a miner like BHP who knows how to mine and keeps production up, they're going to take advantage of the elevated prices. So of all the diversified miners, I think BHP stands at the top.
All right, so let's get your view on that counter then, Alex. And before maybe your view, do you think the 50% copper tariff is going to stick? I mean, we know Trump is one to backpedal on those tariffs.
Your bet as good as mine, we don't know, but I'm sure that some of the businesses and so forth will come talk to him and say, listen, that doesn't make sense. So I'll be surprised if that does stick. But moving on to Billiton, if you look, since this view is looking for a long-term view, if you look at Billiton's EBITDA margins, it's quite stable over time, even though they've got a different diversified portfolio. So that shows you the quality. So this is still if you have to buy a diversified resource company in South Africa, it's probably the Billiton one because it gives you that stable type of returns. Usually it's always got a strong balance sheet, good cash generation, and conservative and good dividends as well, and conservatively managed. Right, so I think I like that. They obviously are very bullish on copper, and we know they are sniffing at Anglo American's assets. So that is something to keep following. Are they going to overpay for those assets? Perhaps we don't know. And because of Billiton's size, it makes it quite difficult to do meaningful M&A. So that is a potential risk to consider if you want to hold it longer term. They might do a value destructive deal. On a shorter end of, obviously iron ore at the moment is a little bit under pressure, and it's very important to Billiton. So if this particular viewer is bullish on copper but doesn't have a view on iron ore, negative iron ore, then you have to be careful because Billiton will then lose and gain at the same time. It's not a pure play on copper. So that's something to think about. And if you look at this production update, yes, production numbers were quite good, but the cost guidance was perhaps a little bit higher than perhaps market was looking for. So, and that's something we need to monitor now in this tariff world. If you do see cost input type of inflation, and that eats into the margins, these miners could potentially disappoint. There's something to think about.
All right, let's get your stock picks. Then I'll start with you, Gia. Where are you seeing opportunity at the moment?
Yeah, no, it's in South Africa. It's Altron, and why specifically Altron? I mean, over the past 3 years, it's had quite a good double-digit compounded annual growth rate. And since essentially moving from the traditional IT business and more to Netstar and Altron FinTech, what we've seen is that they've kind of got an annuity-based revenue, and essentially that has buoyed the share price and really kept it quite stable. And I think the management team there is doing really great. So my stock pick for the day is Altron.
Going local with Altron. What about you, Alex?
Yeah, so I'm going for Afrimat. Yes, the last set of results were horrendous, and I think the recovery is probably going to take a bit longer than we'd like to be, but I still back that management has got a good portfolio of assets there, and they will do correct capital allocation over time. So it's clear to us that there's been a major capitulation of shareholders, and that's causing, and they're leaving a lot of money on the table in our view, but are selling the share price quite aggressively. And I think that is giving us a technical opportunity to buy on a cyclical low a business which I think has got a decent opportunity to recover over the medium term. It will not go up in a straight line. They might even disappoint in the next 6 to 12 months. But I think if you want to take a 3-year plus view in Afrimat, this is probably a good time to buy.
All right, gents, thanks so much for your time and joining us this afternoon. That was Kearabilwe Nonyana from Scope Prime Africa and Alex Duys from Umthombo Wealth. Do remember that Stockwatch pre-records on a Monday and Wednesday at 1 p.m. and is live at 6:30 p.m. on a Tuesday and Thursday, while Stockwatch this week is live at 12:30 p.m. on Fridays. Now keep that in mind and keep your questions coming through. For now, that's all from Stockwatch this week, but do stay tuned for lots more coming up right on Business Day TV.